Oh, yeah. It's going to be fun.
Staying
New
alive.
year. New year, new us.
But same us.
That's right.
Same us.
Same us, just bringing it to New Year.
You're better. You're older.
Can you hear yourselves on the microphone?
Oh, yeah.
A little bit.
Is it your
can't
first
hear
time?
anything.
It is your first time. Let's go.
Not my first time.
Boom.
This is my first time.
Is it?
Yeah.
This is going to be fun,
Welcome.
guys.
Newbies.
Yeah.
Welcome.
Let's do it. Thanks for having me.
I'm so glad you guys are here. This is going to be a lot of fun. We've done podcasts and stuff in the past, but what I get tired of trying to be creative, coming up with random topics. The reality is we're all in the real estate, in and around the real estate industry, in finance, commercial, appraisal, all the things. So why not float some relevant, topics that are out there and talk about them, because the market is ever changing.
Yeah, I mean, this is gonna matter in 2 weeks, and then just as you said, I mean, it's gonna change. So having these continual conversations about, hey, we can call back to this podcast and say, what happened from that information that we were talking about? Now we're sitting in Q2. Did that come to fruition? How did that change? Now what's the leading thought in the market going, to the next quarter? So
We don't have to be right. I always tell people I don't have a crystal ball. I would like to.
We could make it look like we can predict the future.
You can be predictive, and we'll have it recorded to come back to.
If you're
That'd be
off
fun.
by a crazy amount, we're definitely going to be
Delete
calling
it.
you out. Oh,
Delete
yeah. Didn't happen.
Delete it.
Let's do a quick round robin here. Who everybody is. Tony, we'll start with you.
All right. My name's Tony Ubaldini. I've been with Core Group for my whole real estate career now. It's been wonderful.
6 years.
6 years, little over 6 years now. Crazy to think it's been
Who's
so
counting?
long. Yeah, exactly. Except for when
Justin
I tell
thought
my
4.
clients I'm experienced, so gotta tell them a number. I graduated from UCF with my degree in real estate, so that's really helped kind of elevate me and my career as well. And yeah, full-time agent, and I'm loving it. I'm really
go.
enjoying what I do.
Do you like the Scott Frost hire?
I think that was a good move. Yeah, he was fun a few years ago, so should be interesting to see if he brings back that. He was like good for that fast offense,
Yeah.
which I thought was a lot of fun to watch, and we're putting up big points, and always funny to see that. Yeah, the football
Yeah.
UCF. He just came back.
So he went to his Nebraska,
Yeah, his alma mater.
back home,
Crashed and burned.
and he did not do well.
No.
It did not translate.
No.
So now, bringing back the magic.
That's the goal. Try to pick
Yeah.
up where he left off, because he left on a high
High.
note. Didn't they go 13-0 that year?
Yeah, undefeated.
Undefeated.
National champions.
And then
It
he
says
left.
it in our
Blake
stadium.
Bortles? That
No, it was not. That was post Blake.
Yeah,
well,
after.
post Blake. Blake's like retired from the NFL now. I mean,
Mackenzie
Blake's long
Milton,
gone.
I think it was the quarterback. And now he's coming back
Was he
as
number 10?
QB coach.
like I remember that.
And
Cool.
Milton, after he got injured, he was lost a year, and then he went to Florida State for a year.
Yeah. Same as Gus.
Yep.
Florida State. They had a good season.
All right, Winger. Hear it. Who are you?
My
What you
name
doing
is
here?
Matthew Winger.
Matthew Winger.
I'm with Prime Mortgage. I'm a loan officer. I've been with Prime we've been open 4 months, 3.5 months. Been with Justin.
Who's counting? I don't know.
I'm definitely counting
Okay.
by the day. Been moved to Florida since October of 2023.
Good year and a half. Been
Uh,
2 years.
So, what experience do you bring now being with Prime? What was your mortgage banking experience prior to Prime?
well, I come from like a depository background, so I'm from the banking world. Prime's a brokerage, so there's just a bit of a difference for far as like regulations. Obviously, at a banking world, we only work with like maybe 1 to 2 different investors. With the brokerage at Prime, we have 21 different investors. So obviously, we have access to a boatload of products that we didn't have at the bank.
Awesome.
Kevin.
So, my name is Kevin Eaton. I'm a commercial broker with eXp Commercial. I have 17 years experience in real estate brokerage and appraising. As Justin said at the top of the intro, I'm a general commercial appraiser too. So, and I've been doing that since 2008. Graduated from Florida State with a real estate degree and entrepreneurship degree. So I love the fact that I can kind of merge both of those degrees into consulting with business owners and investors to kind of help them make a sound decision on where they are now, where they want to be, and take that role in consulting and helping them get to the next phase of wherever they are.
Very cool. I love that. We're gonna have some fun talking about some of these topics today. I'm gonna go through some stuff that's going around. We've had some interesting lawsuits this year or last year in the real estate world, kind of some of the impacts of that, and actually a story we'll talk about additional lawsuits that are coming on the back of that, which are really, changing. It's just created an opportunity for people to jump on this bandwagon of the real estate industry and the improprieties. And as any industry, it's broken, right? There's things that can be done better. It's run by humans, and that's one thing the one thing I always say, like, anytime there's people involved, there's something that could go wrong, right? The hardest part about real estate is the human aspect.
Mm-hmm.
Because we got people on both sides. We got buyers and sellers and emotions and egos and everything else that goes into it. So that's kind of where some of these lawsuits are stemming from. I'm Justin Core. I am a former broker owner of Core Group Real Estate. And now I'm just slowly real estate agent, team lead at Core Group, powered by eXp Realty. We made that eXp change over the course of last year, and man, am I feeling good about it. Everybody else can get a ooh-yah.
Yeah. Oh, yeah. I mean, and that happened just before the NAR settlement release and everything else. So, I mean, I'm sure that, and not having to deal with that. I mean, that was what you had. Why are you able to make the switch in the first place?
Such relief. Having the backing, of the largest real estate brokerage in the world to ever exist. The legal team, the leadership, that could focus on these things. And that was really the precipice of why we left, right? Why we said, hey, this independent stuff it's been a good run. And I think for everything, there's a season, and everything there's a time. And we ran that season where boutique brokerages were really the place to be, because the old brokerage model is antiquated, the XP's really filled that role. But now we're just allowed to go do what we do more of this, be more in front of customers, and really train up our agents to be as successful as possible. So I'm loving that. And then obviously alongside Matt here, we launched Prime and brought the mortgage business in house, which we're having a blast doing. Just another kind of feather in our cap of ways we can serve our clients at the highest possible level. And I think, we're going to talk about Zillow here in a few minutes too.
Sure.
I think, if you are in the mindset that you are trying to solve problems for our customers, trying to make that process better, more efficient, save costs in the process, make it an easier overall one-stop shop experience, then you're always going to be moving in the right direction, right? And that was our mindset here with this. And I believe, we'll talk about it, but I believe that's always been Zillow's goal as well. Even though we may approach it from different angles, I do generally think that is their goal and objective. So why don't we open up with Zillow before we jump into some other ones? Let's roll right into it.
Yeah, we definitely can. I guess real quick to that point, what's been really great is to be that one-stop shop. So it's been wonderful to have buyer consultations right here in the office. And then I can say, Matt, come downstairs, meet our new buyers, and go through a little bit of the pre-approval process, kind of talk them through it. And they can see that we're a whole team here. We've got you on the real estate side, on the lending side, because since post-settlement, this is the key, the puzzle. You really got to have all three people, the buyer, the realtor, and also the lender, working as a really great team. So if we got two of the three solved right here, it's really been good for clients to see us and face-to-face as well, rather than just, here's another phone number for somebody to call that's maybe in a different state. We've got the hands-on right here.
We've done a few of them together. What have you seen to be the biggest benefit when I'm sitting there with you in the same room?
You're a hype man. You definitely do hype me up when the time comes.
I definitely do.
In those buyer consultations, I really want to show value to the clients. And a lot of times, especially if they're first-time home buyers, they don't know the process. So to be able to talk through that with them has been key. So to have you there when I say, hey, what is your have you been pre-approved, or talking a bit about the numbers has been wonderful to be able to have you jump in as that professional
in real time.
And then I'm the professional on the real estate side and the housing side. So it's been great to kind of separate the two.
Yeah. Yeah. I've always thought that relationship is so critically important. And it's hard for, I think, buyers to understand that, especially first-time home buyers, because everything is cost-focused versus value-focused. I think we can be both, right? We have the ability to be super competitive, cost-effective, but the value is Tony knows where to find Matt.
Yes.
Tony knows, because we've all had the experience where lender's on holiday, or out of pocket, or I can't get an answer and I'm afraid to give you the news that I don't have the update, and therefore I'm not going to make calls until I have it, and you leave people with this void of like helplessness. I've got a closing date approaching. I've got money in escrow, right? And like our job is to make sure we've got as many answers and controls, to get us to the finish line as possible. And so that tight relationship with the lenders, critical.
Was there a moment or situation or transaction that happened that kind of created the, hey, I want everything done in-house? Was there a moment where you were like, this isn't going to work. I need someone in my office?
No, the big thing for me was not so much in-house. It was finding, having a lender who was equally motivated to manage the clients that we're working with. I think the challenge I saw in the industry was so many lenders they weren't locked into maybe one team, kind of like ours, right? And so the focus was spread, and that's always going to create, animosity. It's always going to create a challenge or conflicts when, okay, if I've got to drop everything and deal with this, whose do I pick first? Because there's always emergent issues. And so, and that'll inevitably happen here, which is why we're going to have to grow through that as we continue to grow. We're going to have to make sure there's more hands to be able to jump in and solve problems.
For sure.
But yeah, I always hated the idea that my lender, who should be working on getting this, out of underwriting and cleared, was, out to lunch with the Remax agent down the street, trying to earn their future deals. Maybe that's just a selfish thing, but that's how I think is like, because I know, that's the reality is like, you can't do all things. And so how close can we get to having somebody committed to working, exactly with us, focused on the same things, benefiting from the growth, you being able to help Tony grow, and like pushing into each other, knowing that, hey, I got this. That's just such a difference.
It's a game changer for sure.
Absolutely. Something that I notice with you and the lending side is to be able to be flexible or creative, because obviously everybody's different. So some people may need some assistance with closing costs, or some people may want to put more or less down. What's been really helpful is for you to go through those numbers. What does 20% down look like? Okay, you lose PMI, but you're bringing a lot more cash to close. Could we maybe only put 10% down, save you that money for cash to close, and you're paying a little bit more per month? And it's just been my experience that the bigger banks, first of all, when I call in, I have to give a client account number or like a reference number, rather than saying I'm calling about Kevin Eaton, I'm calling about just a number. Whereas with us or with you,
way more personal.
It's very more personal. And that's what we need, especially for these first-time home buyers that really don't know and they are price conscious, for them to understand that we've got a few different options for them, or we've got ways that we can work the numbers differently to make their situation ideal. So that's something else that I appreciate with you, is to be able to have that hands-on, whereas some of the other lenders are, out to lunch or in a different state and you can't get a hold of them. Whereas here, if you don't answer the phone, I'm running downstairs and seeing where you're at.
Yes, you are.
And so, as we're in an ever-changing, especially, what we saw last year, what Zillow is doing, to try to maybe stay ahead of that and gain a little bit more market share, more than what they had, I guess, in a way. But they're just kind of launching into, okay, what is this new phase of post-NAR settlement look like for them to capture and control a little bit more of the market? So you want to jump into that?
Yeah.
Yeah, let's jump into this story.
So this article just came out. It was on Business Insider, came out a couple of weeks ago, and it's discussing Zillow's Zestimate. And so love-hate relationship with those Zestimates for us as realtors or as agents, but also for the client themselves. The article was discussing how off the Zestimate is. So I was wondering, obviously not too many agents here, but have you ever been in this situation where a client has been so dead set on what that number online, the Zestimate, says, where even though it's maybe more than the market value, or when I get in the house, I notice that X, Y, and Z is wrong with the house, your value isn't where it says to be, but a client's like dead set on that? Have you seen those situations arise?
I like the fact that there is some number that you can talk to and point to. Because a lot of times when I'm working with someone, they have a perceived number in their mind, whether it's justifiable in any way or not. So at least the Zestimate gives you a talking point to say, hey, I've actually looked at the market data and looked at your house specifically. Because all the Zestimate is just a mass model of pulling data here and trying to make it fit to your property that may be very unique. So at least it gives you a talking point, to say, okay, you point to that and say, here's why it's wrong, or here's why it's supported, whatever the case may be. But on the commercial side, there's not a leading indicator of, okay, what's my property worth? And so you'll have one owner meet with a broker and they'll say, oh, this is what I can bring it to market for. Have it not be based on anything. And then they come to me and say, oh, here's what I'm saying that your property is worth. And I have to then go in and say, all right, well, that guy's probably trying to get your business, just so you can sign. But I'm going to take a little bit of different approach and say, I can tell you if based on the data, here's what's selling. If it's, if list to actually contract takes 8 months, and here's what the pricing of those properties are. Well, if you're outside that window, here's what that's going to, you're going to have the property on for, 8 to 12 months, and just having them understand and see the pros and cons of where that pricing ultimately takes you. The Zillow Zestimate gives you that opportunity to point to and say, how can I either support that based on the data of your specific property applied to yours, or have it refute it?
So I think Zillow, for what it's worth, does a really good job with their algorithm. Like, I think the algorithm is very good. I think the places where it falls short is obviously understanding condition and upgrades and key geographical features. So like, a house that's across the street from a house that's on a lake, if that lake house is impacting the value of the non-lake house, that's obviously not a correct approach. We would be evaluating it compared to other houses not on a lake,
yep.
Right? And so you get this trending hypermarket average that is impacted by the really good stuff and the really bad stuff. And so in some markets, maybe the average is sufficient because of the amount of data points. But in some markets, the good stuff completely outweighs the crap across the street, and puts these unreasonable, unrealistic values on it. Something that I learned, so I was at Zillow conference, Zillow Unlock conference in October, November in Vegas. And so in all fairness, we are a Zillow Flex team. So for sake of this conversation,
shout out to Zillow.
We do, help customers that use Zillow, and for all intents and purposes, we use Zillow. Like, it's amazing how many agents are like, "Hey, send me that property," and they send you a Zillow link, right?
Definitely.
Because it is a great tool, great feature. I think they've best in class for sure. people can argue me on Redfin, Realtor.com. Forget about it. Forget Zillow's better. Got it. They are using AI now to review property photos. That is a qualitative addition to their algorithm.
Is that new?
Very new.
Yeah.
Yeah. But how interesting, right? Like,
Definitely.
because forever it's been, and I've done some in-depth dig on their algorithm, right? It's like every data point gets an allocation of value, right? So every bedroom gets some allocation. The square foot of the lot gets some allocation, but that's all relative to the general market area. I think, it's almost like they're trying to, the algorithm is almost commoditizing home values, which I think everyone would be like, we're there with cars pretty much, right? Like, okay, like Carvana's done that, right? Now, could you get a little more, a little less if you bought it private? Or sure. Like, there's always going to be those little market variations for convenience or opportunistic or whatever, right? Like, maybe you could do better if you work really hard, but they've really kind of commoditized. We know we can take, an 80,000 mile 4Runner and fix it. They still make 4Runners? I don't know. I'm not a car guy, but the goal is obviously they can do that with the house, right? Like, but what that to me, it seems like it's going to create is opportunities for super in the know buyers in markets to know that this one is always going to be more valued than that one because of, some of its external features or its location or this street's better than that street. Like, so I don't know that it'll ever be truly commoditized. You could totally commoditize it in brand new communities. I mean, you could put, for the most part, if you do a big circle, they all back to conservation. There's almost zero difference. Some will be a little more depreciated than others because of how people live, but those are fixable things. So I don't know. It's very interesting to me kind of how this looks in the future.
How often do you guys use Zillow when you're establishing your CRM? You guys ever use it?
I look at it because I know my clients are looking at it. So I include it as a data point, but to Justin's point, they don't know the condition, they don't know the upgrades. So maybe I sit down, and per this article, they said that they are roughly 7.5% off error rate for the Zestimate.
For the off-market ones and 2.4 for the on-market.
That's right. So if we're off by, we're talking hundreds of thousands of dollars for a purchase price, that could be.
You work at a big price point, dude.
Definitely been up in it.
Yeah.
Yeah. So that could be a big error rate there. So I guess something that I'm curious, instead of giving an actual Zestimate number, what are your thoughts on maybe a range of values that Zillow could say, we feel pretty confident that you're within a $15,000 limit, depending on what you've done or not done?
They do that.
They do
right?
that?
You can see the range.
Perfect.
I think what they saw, and that story kind of alludes to it, that when they released it, it just got eyeballs. People were saying it was like getting an investment statement, right?
Yeah.
It was like, boom, my house is worth $522,000. Only bought it for $425 3 years ago, right? And it was like this, like,
Yeah, underneath the
selling it or not.
Zestimate, there's a range.
Oh, perfect. Yeah.
Yeah. So, but they like in that, and that's why they have it big and bolded. Is here's your Zestimate.
Yep.
Because it gives you some actual, like, that's the number.
Speaking of price point, where are those pants from? Those Lulu?
BYLT, built.
BYLT.
I love
man.
it. Yeah.
I know.
Big brand.
I'm just noticing the stitch on those. Look
Similar
rich.
to definitely Lulu. Very similar quality.
Thread count.
Thanks for looking it out. Yeah.
Yeah, dude. You got the what do you call it when it's trimmed at the end, the way the hipsters do it?
Fashionable.
Okay.
That's classic.
It's called in right now.
So what would you say to somebody, trying to, use the Zestimate right now to kind of understand what their house is worth?
Yeah, I'm able to talk through it because I'm able to show them the comps. So if I'm sitting down with a seller that thinks that their property is worth a astronomically high price point, I'm able to show them based on my CMA that I've made adjustments for homes in the neighborhood. And the reason that this one sold for so much higher, look at these pictures, granite countertops, new roof, all the major upgrades here. And we're sitting in your home that hasn't been touched in 15 years. So maybe your home isn't worth as high of a premium here. Mm-hmm. And then we get back to the reason for selling. So
Yeah.
are you moving out of state? You guys need a bigger home, things of that sort to be able to help. We obviously want to make them the most, but the goal here is to sell their home, and we need to have a willing and able buyer agree to that price point as well.
Yeah. The other thing with the algorithm is it is based on historical data, right? Same as an appraisal. Like the appraisal is, as far as I'm concerned, kind of, this may be offensive.
Uh-oh.
Okay.
Well, I don't know what you're going to say.
I think it's kind of worthless the moment it's printed.
That's offensive.
Well, because you're looking in the past, and it's only, it's as of the date of the report, that's when it's valid. Now, if market data that isn't included in that appraisal is now available the next day, let's say there's, a listing that, for whatever reason the appraiser couldn't consider, and it closes the next day, that has a dramatic change on now what the estimate of value is. So yeah, I mean, it's as of that date, and also as of the data that specific person
Pulls.
Yeah. And that's where you see these mass differences, is because, you have to have the market competency, to be able to do it. And with these appraisal management companies, and who is tapped as the appraiser in that given transaction, they may be outside of the market, and they may have a good understanding of it, but they're not as deeply tapped into it as the realtor that's sold 15 homes within that community.
Certainly.
So it, and at the end of the day, outside of just an algorithm perspective, the appraisal is still an art, because it's going past the numbers and being able to apply it specifically to a property that, a computer can't do that. So in the same ways that you hate on an appraiser for potentially blowing up a deal, they're there as a check and balance in the system. And I feel like when we went through the housing bubble, there's now additional checks and balances on that human element, which helps, but it also hinders how an appraiser can ultimately conclude the value, because there's all these requirements and limitations put on them. So it's a benefit, but it also, going back to your point, you can't consider any listings, and even if it's potentially under contract or about to close, that you can't conclude to that.
I could see a day, this may be far-fetched, but I could see a day where mortgage securities are wholly based on this algorithmic figure of value, and then anything over that has to be paid for by the buyer, where you've got to just put more down, where they do start to commoditize values, right? So if you feel that I want that house because they've done all these extra things, it's like a pool. The lender just doesn't see, the appraisers don't see a lot of value in a pool. $100,000 pool is like a hole in the ground now in Florida, right?
Not valuable.
But the appraisers are only going to give it $20,000, $25,000,
because they have limits on what they can adjust for.
and so that's a key example of if you have a buyer that has to have a pool, there's a house next door and it's $100,000 more because they just put in that $100,000 pool, and this one's $100,000 less. If they want the one with the pool because they can avoid the headache, of going through the process of building it, but the appraiser is only going to give them, $75,000 less than that value. The buyer already has to put that additional $75,000 up, or adjust their down payment, loan structure, et cetera, right? To get creative with that. Like, I kind of see like we're going that direction already. Like, that would be a key example, because the market sees value there. It's the lending arm that does not.
Do you think there's an algorithm for that, though? That human element, that someone's going to be willing to pay $100,000 additional for a pool, whereas the market says no, it's not worth $100,000.
Well, imagine if your house right now, you knew that the number it's worth is $500,000, and you're probably only going to get so much, maybe more or less in the marketplace than that. And so at that point, we don't need a lender. We don't need anybody evaluating it. I mean, we don't need an appraiser. We start to see costs come down because we're streamlining the speed at which we know what something, that the contingencies are irrelevant because we know they'll lend on that as long as you can qualify. So, I don't know.
And they've kind of been moving towards that with increasing the threshold, the lending threshold to go into a different class of loan, right? So I don't know what you guys, how you call it with like Fannie Mae and Freddie Mac have increased the
non-conforming conforming.
Correct.
Yeah.
So with non-conforming to conforming, if you have or kind of the increase in the jumbo loan, trigger where there's less requirements if you fall under that, where a lot of times banks will have kind of their desk appraisal, if you will, and then it's under that limit, then there's less requirements for, an appraisal to really go through. So on the residential side, that number keeps going higher and higher. So it brings in, in these scenarios where, you have an algorithmic type, desk appraisal, and then just from a collateral standpoint, they're going to have an appraiser go out and, be a check to that.
All right. We were talking appraisal. And you had a question for Kevin on that.
Yeah. I asked, at the bank, well, especially at the bank, whenever we would get a purchase contract and we get an appraisal, the value always came back. It would match identical to whatever the purchase price was. And I was always wondering, like, is that something you guys are taught? Is that something that just happens by default? Is that because you guys are trying to create a smooth transaction? Like, what's the idea behind that?
It's
safe.
It's kind of twofold. I mean, the contract price, typically they provide that. So in the role of the appraiser is just to be there to make sure that the collateral that's being put up for that property is sufficient. And so they're not going to, if it meets that requirement, they're not going to go, and a lot of times they're not going to go above if it's right there, within a couple $1,000s, that they're going to not go over that, because then that's creating the problem of, increasing, appraisal values, and it's adding to that, potentially run up in value.
I always assumed it was a lazy appraiser.
I'll add a layer to that. So 2012, 2013, they roll out where everything's arm's length. You have these ACMs who are between lender and appraiser, right?
And this is post 2008, 9.
So fixing an issue, right? The goal was that they were fixing issues, adds more layers to it. Here's the challenge. False incentive to not overvalue appraisals has come into play, because when you the AMCs, they look at their algorithmic range of acceptable data and evaluate it to see, hey, is this in line with where we feel the value is? Because if, let's say, the market trend is like a $500,000 and you're putting up a $600,000, there better be darn good evidence that it is worth an extra $100,000. And so what happens is you put up that, maybe it's perfectly validated, the appraisal's good, but it's going to get red flagged. And that appraiser is going to get called back to give additional supporting data to say, hey, why are you so far out of our range of acceptability? And so what that process has forced appraisers to do is like, why am I going to
open this can of worms? Yeah.
If I can get there, I'm going to give them the data and I'm going to pick that price. Because you'll see, you can read through these things and they talk about how they weight different properties and this and that. And you might have a really good argument, but then you see, well, if I weighted it this way and I averaged all these, I still don't come up with this number, right? But they land the plane just so that, otherwise this appraisal it's a private appraisal. It's not for any other purpose. It's not going into the world as the current market value. It's just validating that for the buyer.
I have another question for you. So when you're valuing a property, and obviously you see the comparables, you see comparable 1, 2, 3, 4, and then it starts at 500,000, and then you see the next properties at 650, and then you see all the adjustments. Is there a formula to that? Is that just, okay, I think this extra land's worth 20,000 plus 20,000. I think this, is there a formula that you guys come up with and everybody uses the same thing, or you just spitballing that?
You're talking about so there's two adjustments. There's qualitative and quantitative.
So like all the line items when you see.
So all the line items, those are done based on a percentage basis, typically.
So that's not human. Like there's no human error to that. There's a formula.
Oh no, there's definitely human error to it. Yeah, but
that's good to know.
It's quantitative. So you're actually taking a percentage, and some of these are, these percentages could be given as a range from a Marshall and Swift, valuation estimate that goes based upon construction costs less depreciation. So they're taking that number and saying, okay, what does that represent as a percentage? All right, well that's going to be the adjustment. In others, it's okay. Typical properties, they'll sell for 10% less, given one less bedroom or something like that. And that's the algorithm,
that's
aspect
the part of it.
But the other, see, on the commercial side, you do quantitative adjustments, but a lot of time it's more qualitative. Is it superior to the subject or inferior? So, and the reason they're doing that too is because they have a requirement where they can only consider sales within a certain period of time of that engagement date.
Yep.
For that contract. So, a lot of times if some of the, the sales that they are right across the street or in the same community, they can't use because they're not within that date, then they're having to make something else fit to get, that four comp, total.
Yeah.
Then, that's what they're going to do.
We got to move on to some other stories here. So this story just came out. Said headline was 73% of U.S. mortgage borrowers currently have an interest rate below 5%. When you read this, it refers to mortgage borrowers as anyone having a mortgage, right? So this was in the kind of the current data. The story though is, I'll just read here a little bit of it. Before borrowing costs surged, a remarkable 85.5% of U.S. mortgage borrowers had interest rates below 5%. This was in Q1 of 2022. So 85% of the market, homeowners with mortgages, were below 5%. However, as mortgage rates remain higher for longer, that share continues to shrink. So we're going down quite dramatically. Most new borrowers are now predominantly taking out loans with rates 6 or 7%. Indeed, according to newly released third quarter data from the FHFA, 73.3% of U.S. mortgage borrowers currently have interest rates below. So it's gone down, 12, percentage points in across the country. So the question is what impact does this have on the market? Are we starting to see, obviously that's been a big reason while people have been sitting on their hands and not moving. So what are you guys seeing out there? How much of an impact is this for somebody to make a decision to move?
Well, it's good statistic to hear. And unfortunately, I'm the third of the people above the 5%. So
you need to refinance, Tony?
I may need to refinance here shortly. What it came back down to for me is obviously the interest rate and the number is important, but needing to make the move for myself. So I think that obviously we have seen a lot of people hold off on move. Maybe this house that is a little bit too tight for us, we can live in for a little bit longer, but there will become a breaking point where we have to have an additional bedroom, or the kids are getting older and we just need some additional space where the 1 or 2% more doesn't make or break the difference for this family to be able to make the move. So I think it's a really cool statistic to see, but as I think this year we see more and more real estate moving, I think more people will be willing to go outside that sub 5 rate for the right house in the right location, or for the right family needs, I guess, and not being so price conscious, because back in COVID, I'm not sure we're going to see those 3% rates anymore.
What jumped out to me is that's such high percentage. You would think, if anything, it would be closer to 50%, I know there was a huge push to, for refinancing.
It was insane. The whole country refinance, everybody.
Yeah. And, from the lender side, do you see that wave happening again? And what is going to be that trigger?
It happened for a second on September 17th when the feds said they were going to reduce the interest rates by 50 basis points, but we've just seen it steadily
You had
increase
to be
since
ready
then.
to lock in at that moment, though, because then it
Yeah.
trickling right back up. So what did we opened the year at what kind of rate right now are we seeing across the board?
7.
Yeah, I think that was the line I saw. It was like 7.07. You know, it was kind of the opening kind of average market. So, and this goes on the back of this other story that came out that just said, and we've been talking about this for essentially the fourth quarter internally, but U.S. existing home sales are set to close at 4.04 million in 2024, marking the worst year since 1995.
Can we backtrack for a second though? Because I feel like with the interest rates being so low on a bulk of the mortgages across the country, doesn't that mean no one's going to sell the property? Like, are you guys seeing less listings because of that? They're going to want to keep that interest rate.
That's been the whole crux of it all.
Yeah, and you know, you see a lot of these these investors, buyers saying, how do I, if there's not an assumable loan, how do I buy that with that interest rate? You know, and there's a lot of different guys that are going out, you know, kind of throwing, you know, a subject to, or, you know, buying it with, you know, prior to them purchasing it, having it transferred into a trust. You know, and those instances are out there, and yeah, I mean, you can make that work, but for the large majority of people, and usually those instances where those owners are underwater, in essence, like they'd have to come to closing with money just to be able to move. So that makes it ripe for an investor that comes in and says, hey, I will take this issue off your hands. I'm willing to pay you this, so you don't have to pay money out of pocket. So there's those situations exist, but for the vast majority, it's there's going to be that number where the interest rate comes within. And what is that that what you mentioned about for every quarter point of interest, how does that factor in terms of affordability?
Every percent. So we're going from 7 to 6, 10% affordability.
Yeah.
Okay, so you go from 7 to 5, you're 20% more affordable. And so, yeah, we're going to see people refinance the whole way down. Although we're probably going to see, you know, in regards to this story, that 5% benchmark. And I don't know why they use 5% benchmark. It's just, you know, that's kind of was that ceiling that everyone was under for.
Yeah.
We may see that, you know, the new reality move to 6, and we'll be saying how many people are below 6, you know, and then we have these little dips in time where you have the ability to refinance, and the goal is always getting it down as far as you can based on your need, right? Based on the cost to get it down, because there's costs that come with that. And that's what we talk about all the time is like, you know, refinancing is great, but there's a recovery time of the cost to actually refinance. I mean, there's expense in that.
Yeah.
Let me read this story because this goes to your question of like, were people sitting on their hands not moving? And yeah, 100%. We had a demand issue last year.
Definitely.
Right? So U.S. existing home sales are set to close at 4.04 million in 2024, marking the worst year since 95. Sales are set to be even lower than during 2008 financial crisis. The lack of demand for existing homes come as home prices have jumped over 50% since 2020. Over the same period, mortgage rates have nearly tripled, making affordability even worse. Sounds crazy when you say tripled.
It has.
The average rate on 30-year mortgage is up 100 basis points since September alone to 7.1, despite the Fed cutting rates by 100 basis points. So just for reference, so 4.04 million sales in the U.S. in 2004, 2005, not healthy times, right? We're not going to, but just for reference, we were about 6 million to 6.5 million or 6.25 million during that point. So was that 50% more sales during that period, which led to the crash?
I was going to say there.
Well, let's go look at
a lot
20.
going on.
Well, and it wasn't a market. It wasn't a market issue. It was a underwriting and loan issue,
which creates demand.
People were originating mortgages
Right.
that.
Yeah. So I mean, and so to me, it wasn't. You know, okay. There was the demand issue relating to the lending improprieties. So I don't think that was an imbalance.
But that happens with price too, right? So then prices go down, financing ability gets, stricter, right? But then you still create, because that's what took us into this upward trend year over year from the bottom in 2008, right? We had roughly the same as this year. So 4 million or whatever.
Well, and it's the pendulum swing, so from COVID, with all the money that was being pumped into everybody's pockets, then, the pendulum swinging back. So there has to be that correction. So we're still within that correction. Was this year as much correction it was needed to then get back to what's normal.
And when we're talking about transactions, we're not talking about values. And so, and it's an interesting experiment, I think, for buyers and sellers, investors specifically, to look back on trends of transaction volume coupled with price data, right? And value, because those two things are not always in line, right?
Because price and demand has been this past year. So there's going to be a breaking point that tries to bring them back together.
Right. Yeah. But actually we've seen prices hold strong amidst very little data, like sales data, right? But when we saw the boom in 2004, 2005, we saw it drop off pretty sharply year over year. Went to 5.5 million, and then down to 4.5 million, and then down to kind of that 4 range in terms of where we are today. But you saw values take that same period of time, almost 3.5 years, to drop. So, I think our purview of time and how long things take to change is so wrong. People are like, oh, it's going to be this year, we're going to have the bottom fall out, right? And it's never this year the bottom falls out. Things happen, but for markets to move, that takes a lot of time.
Well, and usually there's I would say, in historical perspective, the residential housing market reacts at least 2 to 3 years before there's a market reaction on the commercial side. And what has kind of thrown everything into this flux is the amount of money that went into the economy after COVID, during and after COVID, and the rise in interest in inflation, and what happened with interest rates. That's almost kind of creating where there, right now there's this wall of maturities on the commercial, because what's different than residential is where you have a 30-year maturity, where on the commercial for loans, you have a maturity typically at 5 years. So every 5 years, you're having to either get a new loan, either restructure your current loan, or sell the property. So, there's this wall of maturities that are coming in 2025, 26, and 27. There's $2 billion? I
think it's 1.8 trillion due by the end of 2026.
Yeah, and there's almost $1 billion this year in 2025.
Insane.
So there's going to be some of these major loans that are already
coming due.
Well, they're coming due, but they're like, let's say they're 2 years out, they're already going to be restructured. How that sits on the books of these banks, they're going to have that figured out. But as we get in through 2025, 26, some of these smaller banks, what they have in terms of loans, they're going to be less apt, and the liquidity is going to be gone by then to restructure. So it's
what's the mindset of, because this says the story you shared was 544 billion this year. What is the mindset of, let's just say if homeowners had 5-year runs on their debt, right? A 30-year mortgage.
That's exactly where my brain's going right now.
But if you're thinking about it from an investment standpoint, like debt is constantly evolving as part of your investment. So, what's the mindset for commercial property owners, in terms of how they view this in lockstep with time and the management of properties? Like,
so real quick, regardless of rate, commercial lenders are restructuring people's loans every 5 years.
Yeah. Unless you're in a certain product where it allows you to be in, before, let's say 10 years, like if it's a owner occupied property, or, there's a small business administration loan, where you can stretch it out to 10 years, but yeah, every 5 years. So you have to be back to your point, you have to be very conscious of, percentage down, and have you run the stress tests of, hey, if I lose this tenant and my income goes down, and what does that do if my property expenses go up? It's having that range and testing, if for instance my interest cost doubles, where can I make that up? And it's where you buy it, how much equity that you put in at the time, and knowing what those variables are, and that's going to be the trigger for a lot of people when they realize, hey, I was at a sub 4% interest rate, and now I'm at an 8. That doubling of your interest liability. Can you weather that? And you have a devaluing of properties happening too, because as we get on in the market, and as those, I wouldn't say distressed, but they're stressed properties for sure, come on the market and transact, then it's a twofold. It's the property specifically is being potentially devalued because, there's less growth on the rent side. So income that's supporting the value is potentially lower. And you have the stress on the expenses relating to the property,
taxes and insurance and everything.
Yeah,
else.
taxes and insurance. Yeah. Because that's below the line. Any kind of debt service is below the line of when you're getting to a net operating that you're then applying a cap rate to. So debt service is unique to each person. Each.
The other thing that's interesting in commercial, and I've talked to a couple guys in primarily the retail space on this, they are begging to be able to get some of their maybe legacy tenants out, because that's the difference in that space is, right, they've got maybe a 10-20 year lease in some cases. And so if the market's moving faster than your projected rent growth, you might be up in your rents on a 3% annual step up, but we have COVID years where markets are massively in demand, or locations have changed since when you leased it the first time, where they're saying, man, we're waiting for these people to get out, because we want to restructure that financing. We can triple the rent and put new tenants in there tomorrow.
So it's like, anytime an owner has the ability to restructure a lease, it's, you do that with, it's a give and a take, because, if you're structuring a 10-year lease, hey, what's going to happen in those 10 years? And where am I at starting now? Is the escalation within those annual increases going to keep in lockstep with consumer price index, with just overall costs? So you kind of take a guess of what that is. And if you're on the wrong side of that, or let's say you're negotiating within a market that is very tenant advantageous, and you just have to take the deal, that is in turn going to have a negative impact on your value.
Yeah, definitely. Something that I've seen on the residential side is that guess. So during COVID, I had clients that are like, we're in 3% now, but Tony, I'm going to hold off. I read something that we're going down to 2%. And it's amazing for me to witness, because for some people, that's been an objection, and 3% was too much, and they felt like it's going to go down to 2%. Well, now a year later, that values have increased. They're now kicking themselves. I should have got in at 3%. So that's why I always go back to the motivation here. I know for commercial, it's more so making those numbers be exact. But when we're talking residential and we're talking family, maybe there's a little bit additional cost here, but we got you in a house, and you're now putting equity down in a home, as compared to a lot of my clients, first-time home buyers, they're paying rent. They're paying $2,500 a month, not putting it down on a mortgage payment and putting equity into a home. So it's interesting getting so granular on getting the best percentage when now a year up the road, they're maybe kicking themselves that they missed out on that 10% price appreciation, and that would have made up for it.
And that is having an agent that sees that and says, hey, you're very singularly focused on the numbers, and you need to say, hey, on outside, let's pull back.
Yes.
What happens if prices go up 10%? What does that do to your cost then versus where we are sitting today? So running those what if scenarios, and hey, what's likely to happen if you wait, is very valuable in helping to center them to that decision.
My takeaway from this 10-year, 15-year period is, I heard it said really well, either money's cheap or houses are cheap. Very rarely
are they both.
When they both are, you buy. Right? When they both are, you buy, and both cheap over, with historical purview, values being based on, general market affordability. And that's changed a little bit during COVID, which we could go deep on. I think it's a rabbit hole for another day. But the idea that, we know now, looking back, 2018, 2019, values were really good in Florida specifically, and rates were still extremely low into COVID, right? So you had this period of time in 2020, 2021 when you could not make a bad decision. The time to take out debt and buy was then, because things only went up from there. And so not only did the increase in cost of purchasing went up, but the increase of property continued in form of the demand and lack of supply. So that's just, I think it's more of a truism, something that we all need to take to heart and know that there will come a day. And I worked with a handful of investors that had that, from much older than me, that had that understanding, and they put everything they had, everything they could pick up during that period. And we just unloaded a couple portfolios for this older gentleman. He wouldn't sit here to claim to be this super smart, wise guy. He just knew opportunity when he saw it. Cool. We were buying $110,000 condos. We sold for $325. And he picked up 20 of them. Some random land that now is is being developed by. It's like he didn't have a crystal ball. Which I want to ask Tony about this one. So the share of single family homes built with 2 bedrooms or fewer hit its highest level since 2012. And the same share of new homes built with 4 bedrooms fell to its lowest level since 2012, per the National Association of Home Builders. What's the story there?
Yeah, are people not having kids anymore? Is that
affordability?
Is that what it is? It could be, size and affordability as well.
And is it being dictated by the builders or by the market? I mean, or by the buyer preference, I guess is a better way to put it. So is it builders trying to create a smaller home? I mean, because you can create a smaller home and still have the same bedroom
margins,
count. Bedroom count.
Yeah, okay.
Granted, the bedrooms are going to be smaller. Maybe the internal areas are going to be smaller, but the bedroom count stands out to me. Well,
it does, but we know the story that the average home buyer last year was 36 years old. I think that was from the National Association of Realtors report. First time home buyer, average
36
age,
years old.
36.
Wow.
So
And household formation.
Why is that?
And household formation is being delayed too.
Yeah. So we've got a bunch of people 5-10 years into their career, not married, no kids, and we got an affordability crisis. To me, it's clear why they're building these. What kind of longevity do these have? And maybe as they kind of dictate future population growth, they know that, hey, there's going to be continued demand for, because also retirees now would buy. We got baby boomers. That's something I actually haven't thought about. But baby boomers only need smaller homes. They're selling their big family home that they don't need anymore. So you've got 2 separate generations, 2 generations apart,
that need to switch.
that both don't need much, right? Its cost and its bedroom count is not that important.
In residential real estate, are you guys noticing people that aren't forming families, that aren't couples, like two buddies or two girlfriends that aren't in a relationship, do you find that they're buying houses just for like smart investment?
By themselves, I don't see them buying.
You don't see them buying it together? No.
Because there's plenty of people. I mean, and you're both in the demographic.
Yeah.
Right?
Yeah.
Which is wild. Good incomes, good jobs, no kids. You know, and I think too, like you're building these you could put them, builders. One thing I know about builders are going to continue to build. That's all they know how to do. It's like for every, if you're a hammer, everything's a nail, right? Builders just keep building. They have land. They keep finding new land. They're going to keep building. They've got employees to keep employed. And so they're trying to say, hey, how do we get the price point down? Well, we got this whole, I think it's an affordability issue.
Yeah. It's because they can build it on a smaller lot. There's just less material, and so, well, it's not even necessarily higher margins. It's more of, they know the price range they ultimately did be in for it to transact. So, so it's strictly affordability. So, but you can shrink a house and still have a bedroom count that's 3 or 4 bedrooms. I'm just interested the fact that they're going from a 4-bedroom to a 2-bedroom, and that there's
At its highest level versus its lowest level.
Yeah,
They're obviously still building bigger homes,
sure,
just not at the same pace in which they previously.
Well, and the other aspect is, a lot of these home builders have added to their development portfolio build to rent, and there's whole communities that are being built specifically for that. And they're kind of using those build to rent communities as a hedge. Like, hey, if, and they've been starting to build them, and then they can turn right around when they have less supply to go ahead and start converting those into sales. Yeah. So it's that's an interesting aspect.
The big money has time on their side.
Yeah.
Right. They've got the ability to wait out markets. So when there's a lack of, when you've got builders who have, maybe they don't want to build right now because they don't have the demand. They're afraid to get their, ahead of their skis. They can come alongside and say, hey, build the whole community for us. And then we'll just rent it and sit on it until such time that we start selling. So that's that pendulum that the individual investor doesn't have that kind of purview or ability to wait, do they? But it's these big funds that have the time.
Yeah, and the home builders, there was one home builder that had 2,000 homes in its overall master plan, and they were going to be basically bringing it from raw land all the way to finished home, delivered to the market. And they had already, within their models, they had planned 2 downturns. So they already, within their whole build out phase of this 2,000 home master plan, has 2 downturns in the market. So they already work out those numbers.
Wow.
Very cool.
Yeah. Wow. Yeah. Matt, we got time for one more? We got one more. All right. We'll wrap up with one story here. So this is hot off the press, guys.
Okay.
Hot off the press on housingwire.com. But this is what I was talking about in regards to the lawsuits that we're seeing follow some of the.
I knew we were gonna hit on this.
Yeah. So
it's a good one to hit the last.
So all I have to say, NAR was just, the NAR settlement was a massive lawsuit against National Association of Realtors for improper practice of buyer commission income. We've beat this to a pulp. Buyers, if you don't know, you now have to sign a buyer agency agreement before ever seeing a house. We don't like it either. It's here. It does give you some controls in the process. Make sure you find somebody that represents you well. That's all I'll say on that. Find somebody you trust that you're willing to have manage your buying process and going to give you good help. A good buyer's agent is worth gold. I'll tell you that. We talk about these trends in and out of markets and street to street, and like you could have a rounding error on an appraisal or misunderstanding of what an appraisal means and blow $500,000, 7, 8, 10% on a house by paying the wrong price, by not negotiating the right price, by jumping on something because it's available versus being patient and waiting on the market. You know, like you need somebody you trust. Nobody's making perfect buying decisions ever, right? There's always unknowns. All right, this is a story. So I'm gonna read through this. This is a very interesting one, and there's a lot of components here, but I think it's interesting to talk through. So, despite having long ago settled the commission's lawsuit, legal challenges continue to mount for the real estate industry giant Anywhere. I don't know much about Anywhere, but I think they own a lot of. They own quite a few brands in the industry. On Friday, the firm and some of its subsidiaries and agents were accused of violating the federal racketeering RICO. Nobody wants RICO charges. That's no joke. The lawsuit, which alleges claims of false advertising, was filed in a U.S. District Court in Minnesota by plaintiff Michael and Lauren Campoli. They're demanding a jury trial and more than $75 million in punitive damages and compensation for litigation costs and emotional distress. That's the one. That's the one that gets me. All right, let's hear what their case is. According to the suit, the Campolis worked with a Mark Greiger, their neighbor, and an agent brokered at Anywhere, backed by Coldwell Banker Realty, to list their home in Deep Haven, Minnesota for $3.3 million. Before we go any further on this, I'm like, how do you get to $75 million? I mean, assume the guy gave the house away.
Yeah.
How do we get to $75 million?
A lot of stress.
I don't know. Are they trying to get class action status?
It sounds like that kind of, or it's a big show of force,
like
right?
reach.
75, you settle for 5. I don't know.
Yeah.
So defendants Jesse and Lee Bull then made an all cash offer on the property through a shell company, Fairways and Greens LLC.
That's where the RICO comes in.
They're listed for 3.3. They get an all cash offer from this LLC that they set up with their broker, Joel Berger, who is with Wexford Real Estate. The Campolis allege that the Bulls failed to deposit $100,000 in earnest money as agreed to in the contract, instead foregoing documentation falsely showing that the money had been deposited. Okay. Check. That's sketchy. The suit also alleges that defendants, which include brokerages, agents, brokers, support staff, title companies, and banks involved in the transaction, coordinated to gain an unfair advantage. They allegedly withheld the earnest money deposit and misused equitable title by delaying the cancellation of the deal and using their partial claim on the property to extort money from the Campolis. This included pursuing a sham lawsuit and withholding evidence to avoid exposing their alleged scheme. I'm going to fast forward here a little bit. The suit alleges that Coldwell Banker Realty took things as far as depositing $100,000 of its own money into an escrow account to create a false impression that the buyers had in fact made the deposit. Additionally, the plaintiffs claim that Coldwell Banker Realty's actions are reflective of systematic issues in the real estate industry in which brokers fail to uphold fiduciary duties due to financial incentives or conflicts of interest. The Campolis also claim that this behavior violates the Lanham Act. They say Coldwell Banker Realty, Anywhere, and the agents and brokers involved in the transaction falsely claim that they are trustworthy, reliable, and would uphold their fiduciary duties and act. Okay, of course. All that to say, this turning into an alleged claim against the entire real estate industry is wild to me.
Yes.
Because there's always bad apples. That guy should be punished to the full extent of the law, right? Like,
So the real estate brokerage just fronted the $100,000 for the earnest money, or they pretended that was deposited?
that's what it sounds like. No, it sounds like
Did they actually deposit it?
$100,000 and then, but on buyer's behalf, showed a $100,000 deposit, and the buyer had never actually deposited.
Does that matter?
Well, it all matters because that would be somewhat fraudulent. But what's interesting to me is, and I just know this from having been a broker, right, for a long time, is like you could have a rogue agent do something improperly. That doesn't mean Coldwell Banker proper is complicit, right? This is probably a franchise with an agent under it who's operating on his own accord under his own entity, right? The company is a platform. To say that the company, and I'll stand up for Coldwell Banker here just for a minute, is like there's no way the company approves of this tactic, right?
Correct.
So, this idea that they're going from, and I don't know the full extent of like, how did they actually sell the property and not get any money for it? Did they, are they suing them because they just feel like this buyer was never legit? And you've got another brokerage with another agent, right? Another layer to this that brought the offer in the first place. So were they in cahoots?
Yeah, but to me, it's like, to what end?
What was the goal?
Yeah, what was the goal?
Yeah, I don't know. But they're suing everyone involved
Off
and
a technicality?
claiming it as a real estate industry related issue.
Yeah, this could happen to anybody. This could happen to everybody. So we should class action lawsuit against it.
It'd be like having a bad doctor and just saying the whole medical
doctors.
industry's got to go down, or
And the nurses
attorneys get
and the
debarred all the
hospitals.
time.
Oh yeah.
Right. So what's the issues? Like, do we just need stronger ability to like ban people from the industry? Like, is that not happen, at the level in which it should? Like, I know we've got in Florida, we've got FREC, we've got, departments that are responsible for licensing and stuff. But, the idea that like, I don't understand why this becomes such a national story and why an attorney's claiming $75
Well, mainly
million
just
in
because,
damages.
an attorney that's essentially sued the real estate industry just won, and what the payout was to that. So I think that's, they're trying to take this and see how much news and notoriety they can get out of it. I thought you were bringing up the story that, with this NAR settlement, now all of these MLSs are losing control. That is there going to be a privatization of now having a multiple listing service where it was controlled by these few associations, now becoming less powerful because of this settlement, opening the door to having a for lack of a better word, a crowdfunded, agent focused listing service.
National,
Yeah,
or statewide.
it's a national.
I've always thought our MLS system was a hot mess because it is so geographically
Constrained.
concentrated.
Yeah.
When you have the Zillows of the world that make everything available, the only exception is, we upload, attachments and disclosures, and have, for a long time, the big argument of MLS was, offering of compensation internally to agents. That's gone now. Why do we need MLS? I know there's been two major brokerages just released that have announced they're allowing their agents to depart from National Association of Realtors.
Yeah.
And so I think you're going to see a lot more of that in the coming years. We're going to continue to see this thing unfold.
Question on the real estate side. So in the financial sector, in the lending world, we have underwriters, we have compliance, a whole bunch of people overseeing disclosures, the process, making sure everything's accurate. Do you guys have anybody that does that on your end? Who oversees the transaction to make sure that the contract's accurate, the wording's correct, there isn't any...
Well, I mean, there's transaction coordinators. Obviously, the broker, has a role. The managing broker has a role in making sure that files are
separate
compliant.
entity that oversees?
Not into the transaction. Maybe outside of that, there's compliance on the brokerage side. That you have to show that, hey, we've accounted for funds and that all of our files are up to.
Well, there's no
up to
checks
par.
and balances on the contracts or anything like that?
Well, there are. I mean, the reality is you could be pursued legally, if you're doing anything. I mean, there's a civil component of this thing too, right? So we've got standards we've got to uphold. That's been a big part of the industry for a long time. Is that, like in Florida, the Florida Association of Realtors and the bar have come together to create agreeable contracts. But we're not making contracts on an individual basis. We're filling in blanks to agree to standardized terms. And so, yeah, the issue would be if you got like this guy got a little fancy and started trying to create shell games and swindle money out of people, and you should be pursued 100%.
Yeah.
To the full extent of the law, license should be revoked, should never be able to practice again.
Yeah.
And that would solve a lot of these things. This is not a industry wide.
No, and that's kind of a lone agent or, bad agents, trying to, take advantage of a couple in this situation.
Yeah.
And usually they don't have their license anymore. They're fined to the highest extent that, is allowed. And, we've seen over the past year and a half, how many agents have gotten out of the business? And so there'll be that natural filter of, the bad actors or, people that aren't keeping up and don't do this as their day in, day out. So, that's why 2025 is going to be, as the pendulum comes back, it's going to be that much better.
I've had fun talking to you guys today. We should do this again sometime.
I love it.
Absolutely.
We'll bring in
A fan and some air conditioning next
bring
time.
in some more. You take your sleeves
Go
off.
step outside. Freezing outside.
This is my Under Armour.
Good for you, buddy. Hey, it's been fun. Thanks, guys.
Been real, folks.
Good work.
Give us some outro music. Why don't you? Oh, yeah.